Welcome to the Monday Futures Market Outlook for September 27th, 2010. This is Patrick Sresna. For those of you that have not had an opportunity to try out eMiniSource.com's new trading room, 5-day complimentary memberships are available. As always, we've started off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We crossed bullishly above that 80-week moving average back in the late 2009 and have been trading above it since. We've been actually maintained a bearish bias, and I'll show on the chart in a second why up until now. But the scenario that we were saying, in order for us to change to a bullish bias, we would have wanted to see this market consolidation last about 4 to 6 months into the September cycle and find important bottoms somewhere around the 950 to 1,000 level on the S&P. There was obviously room for there to be further testing down the downside in September, but right now we have put in some sort of an important short-term low, and really at this stage with us now starting to break above this 1120 area on the S&P and holding it, we now have to start visiting the idea here that we are now charging up for another weekly chart rally that may last even to the year end, if not into the new year. So at this juncture, that's becoming more and more likely the scenario and would have us change our bias to more bullish one. The reason we've been or reluctant to change our bearish theme is because we have not been able to rule out until now, or at least starting to now rule out the possibility that this was nothing but one secondary corrective pattern that still had another double dip type scenario where the market would come back and decline to retest all of those previous lows. And while at this juncture we still cannot rule that out, it is becoming less and less likely to be that this is the scenario that's going to play out. So next year I want to put up a chart of the S&P 500 E-mini futures contract, and last week brought in a little bit of profit taking, finding some important supports in that 1120, 1130 focal point we've been talking about, and subsequently we had a really nice reversal Friday, and even this morning we tested right up into the 1150 area. That 1150, and there's even another measure move that goes even as high as 1160, but overall these are now still the measured moves on the upside, and while it was really bullish, the reversal we had on Friday, recognize that we still have not had any really good market correction. So what we're really thinking at this stage is we cannot rule out the possibility so long as the market is holding above this 1120, 1130 area, that we can have a market that even rallies up to 1170, 1180. But recognize that whenever we have any good market rally on the upside, they should become shorter in duration and have much quicker, faster profit-taking cycles kicking in as that market is advancing. But nonetheless, if for whatever reason this morning's test of that 1150 area on the futures was a legitimate test, then we would still be looking for any market consolidations, not only to hold 1120, 1130, but there could be a little bit deeper market pullback, even up down to 1100 area on the downside. But so long as all profit-taking cycles are contained and the bulls dig in on every time the market sells downwards, we'll always be looking for at this juncture for the market to roll up and make pushes to higher highs. So we're just going to be watching where and how the market holds up at this breakout level on the upside. Just to review our key points, again, our thesis since January 2008 has been that we're in a secular bear market. Again, we're on the verge of shifting to a bullish stance. If the current market continues to strengthen from these technical levels, we're completed a measured move up into this 1150 area this morning. And while the market remains positive, recognize that profit-taking cycles could naturally happen off of these levels. If the bulls keep defending these support lines during any of these profit-taking cycles, we'll start to focus on the market rallying to the year highs set up around the 1200 to 1230 area on the upside of the S&P. So investors can cautiously start committing to the market, and particularly during market consolidations that find support would always be a good time to consider accumulation. Next year, I want to take a look at the E-mini NASDAQ 100, and this is sort of why I'm concerned about the market as well. And the NASDAQ has truly been the leadership sector in this entire market rally driven by Apple Computer and stocks like that. And as you can see here, we've now already hit the year highs, while the S&P has got still quite a bit of work to do to get back up into this level. But recognize how overbought that NASDAQ is, and in spite of the fact that the S&P looks charged up to go, the NASDAQ is reaching some significant overhead resistance that could drive profit taking. And if we have profit taking in NASDAQ, it could very well shift over into the S&P and create some of those little profit taking cycles. Again, that does not make us bearish, but it's just the markets don't go up in a straight line. And with the fact that we're now coming up into these overhead resistance levels here, it would be very natural for us to see profit taking. Next here, I want to look at the dollar index futures, and this is actually an important critical piece of information because if this dollar index continues to weaken, that actually could very well be the catalyst that creates a NASDAQ breakout to a new year high, as well as the S&P heading right up towards its previous year highs around that 1200 plus area on the upside. If this dollar index breaks this support line at the 79.50 to 80, it's already broken the low of August. But if this support line is broken off this consolidation zone that extends all the way back into the start of the year, then we would probably find ourselves all the way down to the 77, 78 area. That would drive a crude oil rally, maybe further strengthening in gold and other commodities such as copper. But also it would be a very good catalyst for driving the S&P up to those higher levels. If for whatever reason the dollar index found support here and bounced back toward 81, 82 or higher on the upside, that would work nicely in line with the markets correcting. So we'll be watching for the cue from the US dollar as to which way the markets are going to drive. Next here, I want to take a look at gold futures, and what certainly has been the kicker for pushing gold to higher highs has certainly been the weakening US dollar. Ever since that last wave of major dollar index consolidation has really kind of sparked further strengthening in gold. Again, if the dollar index breaks down and heads towards that 77, 78, gold will naturally pop right up into that 1330, 1340. And there's another measured move that even goes as high as 1385. Recognize that we, on the very short term, we continue to respect this trend and certainly will not rule out the possibility that it will go higher. But recognize that when gold finally finishes these moves, the profit-taking cycle is always very sharp and steep. And so really at this stage, it would be very prudent into this further strength to continue to reduce your position sizes in gold into the strength. Next here, I want to take a look at the E-mini crude oil futures contract. And crude oil, like we were talking about last week, was creating this kind of bearish flag. But at the same time, we said so long as the dollar index is breaking down, there's very little catalyst for crude oil to actually make that move down to those lower measured moves. So you can see crude oil has started to strengthen a little bit, heading right back to the highs from earlier this September, right marked off in that blue zone. If the dollar index again makes that breakdown move below the 79.50 area and really starts to accelerate, we certainly will see crude oil make an attempted breakout above 78 and maybe even go for a test of the summer highs up in that 81, 83 area. And so really we'll be watching whether that dollar index gives the cue for these intermarket relationships to start kicking in. Finally, I want to look at the 10-year Treasury notes, and this is a very relevant chart. We continue to actually have a very bullish trending 10-year Treasury note, which means yields are still actually at really low levels. This is the only major conflicting piece of information in the whole picture. I mean, if the whole area and everything was recovering and the markets were very healthy, we should see the Treasury notes, even the 30 and 10 years, struggling and eventually even topping out. So I'll be very curious to see whether 10-year Treasury notes creates a double top along this zone and whether this overhead resistance resistance is significant. If it isn't, the 10-year Treasury note can head all the way to $29. If the headline news starts coming out that 10-year Treasury notes are at all-time highs and the yields are at those historic lows, that may very well be enough media attention to spark that profit-taking cycle in the market. So double top right here without it breaking to higher highs would certainly make further support for a bullish, the bull's case scenario. Again, we'll want to see whether that overhead resistance here rejects this go around. That was your Monday Futures Market Outlook. Thank you for joining me.